comparatively, apples to apples, if you take the right tenor, then and the right kind of debt product, then there is a marginally superior rate as well. And I presume the benefits of indexation come in as the tenure of your holding moves up slightly as well.
That's very true because the way debt is being taxed is very, very different. Debt mutual funds are being taxed very, very differently. For instance, right now, just focus on the top line. That is the without considering taxation, debt mutual funds are far superior because suppose your bank FD where interest come every 3 months or 6 months, or your corporate FD or your corporate NCD. If you don't have, if you're not compounded, then what happens? That the interest get completely vested. In debt mutual fund, there's no leakages of interest being not reinvested. It get reinvested very, very efficiently. Even you compound in debt mutual fund, or sorry, in bank FD or corporate FD, there's a TDS, there's annual tax outgo. So to that extent, your compounding doesn't happen that effectively. In debt mutual fund, till you take money out, first of all, there's a no taxation at all. So there's no annual tax provision you need to make. That is the one thing one need to keep in mind. Second, suppose your holding period is more than 3 months, then the way tax mutual fund get taxed is that your cost is increased by 75% of the inflation number.
Three
Suppose
years.
yes, so in a 3 year plus, suppose let's take for very simplistic reason, in next 3 year inflation happened to be 6%. So we are not compounding, we are taking a simple number. So 6 plus 6 plus 6, 18%. Now CI cost inflation index is 75% of CPI inflation. So 6% ka 75% is 4.5%. So 4.5% plus 4.5% plus 4.5%. So it's become 113.5. I'm not taking compounding, I'm just making a simple. So if in a debt mutual fund, your 1 lakh at the end of 3 years become 1,21,000, then 1,13,500 is your cost. And the gap is only treated as a capital gain. On that, you pay 20% tax. So effectively, your tax rate, incidentally, in debt mutual fund, the average taxation rate of a last 20-year data suggests that it has been lower than equity mutual fund. So it is a far, far more tax efficient way to look at investing. And Neeraj, one need to keep two things also in mind. We pay 10%, 20, 30, 37, 39% tax. We don't have a choice as long as we are earning. Beside that, we pay 20% indirect tax on all the consumption item we have. Now we keep complaining about higher tax rate. We keep complaining about higher GST on the consumption item. But as far as investment concerned, there's a choice given by the government. I don't know why we are not utilizing it effectively.
Sure. So viewers, remember what Vijay was trying to say is that your cost remains the same, but for the purpose of taxation, the cost moves up. So for a calculation purpose, the example that he gave of 100 moving to 113 and a half, that will be the deemed cost. Your actual cost is of course 100. Your deemed cost is 113, and therefore the tax that you have to pay is only in the difference of 121 minus 113.5, as opposed to the normal instrument wherein the entire gain of whatever 18, 19, 20, 21, they'll have to pay tax on that. But I think what Vijay Mantri's done and his team have done very effectively is give us some more math around corporate FDs versus debt MFs with an example of a tenure of 60 months. So let's say that you have the wherewithal, viewers, to invest for 60 months, which is 5 years. Now, Vijay, here's where I loved the way you explained this, and I would love you to take some time and tell us at different tax slabs the corporate FD versus debt mutual funds, the returns that come in, and then of course the kind of returns needed to match the corporate FD, and of course the category for the same.
So it's very, very interesting. Suppose you have a 7.5% corporate FD, and you bought that FD, and you bought this FD with compounding. So 1 lakh rupees invested, and suppose you are not paying any tax, 1 lakh become 1,43,000 at the end of 5 year in corporate FD. To match that, a debt mutual fund need to compound your money at 7.5%. Today we have many product, medium term, corporate bond, PSU bond, where YTM has been from 7.70 to 863%. By the way, in all three category, in last 10 years, where the FD rate has been very low. In all these category, the return has been 7 for last 10 years, where the FD rate has been very, very low. So even in the last 10 years, they have done very well. Now we're talking about elevated rate of interest. So going forward, I don't see why all these debt fund will not able to beat 7.5%. Suppose we take 0% taxation. But suppose you're in 10% tax bracket, then at the end of 5 years, your 1 lakh become 1 lakh 38,000, 1 lakh 39,000. Debt mutual fund after paying tax will become 1 lakh 39,000. Effectively, debt mutual fund need to deliver 7.4% effective to match the 7.5% corporate FD rate. And that is low duration and medium term fund can do very, very easily. Suppose you are on 20-year tax bracket, then 1 lakh become 1 lakh 34,000 rupees and mutual fund has 1 lakh 39,000. To match corporate FD rate, a debt mutual fund need to compound only at 6.48%, where you have ultra short-term money market, YTM close to 7.5, 775. If you're on 30% tax bracket, then 1 lakh actually become 1 lakh 29,000 rupees at the end of 5 years. In a debt mutual fund, for the same tax bracket person, 1 lakh become 1 lakh 39,000. Effective yield on corporate FD is 5.56%. Effective yield on a debt mutual fund is 7.4%. Even liquid fund will outperform because current YTM of liquid fund is 7.2%. And suppose you're on 37% tax bracket, then 1 lakh actually at the end of 5 years become 1 lakh 26,000 rupees. In debt mutual fund is 1 lakh 39,000 rupees. Effective yield, if you're in 37% tax bracket, then on 7.5% bank FD's effective yield is below 5%, which actually call money can easily outperform. Current call money rate is 6.2%. But if you look at last 10-year data of call money funds, on average, they deliver 6% compounded return for a 10-year period. So though corporate FD give you some comfort, bank FD give you some comfort of predictability of the investment performance, real data clearly shows the debt mutual fund outperforms corporate FD and bank FD by huge margin. And one need to keep it very simple. If the banks are offering higher interest rate on FD, if the corporates are offering higher interest rate on FD, it means that they're also offering higher interest rate on the publicly traded instrument. So whether corporate issued CP, corporate issues NCD, or bank issue NCDs, bank issue CDs. So those products are being captured by mutual fund, and mutual market rate move faster either way. So what does bank do when interest rates are rising? They do not increase their deposit rates immediately. They do with a time lag, and they don't do full quantity. But the loan rate get repriced very, very fast. But in debt mutual fund, it captures the market rates. So what happens if the interest rate goes up in the economy, the debt mutual fund get repriced very, very efficiently. So I have looked at data for last 20, 25 years. I have no doubt in my mind that except what we have seen in 2018 and 20, there was a little hiccup on debt mutual fund. But debt mutual fund has added significant value to the investor with or without taxation.